Hello everyone, welcome to the 79th episode of me learning how to trade in Forex. So in the last video we finished off the trading divergences lessons. We learned that basically divergences are not a trade signal but just used as an indicator. So you meant to combine divergences with other indicators to use, so like candlestick patterns or trend lines. Yeah, and regular divergences help you collect a big chunk of profit, and hidden divergences can help you ride a trade longer. And then we did the quiz, and now we are on to know your trading environment. So let's get started. Know your trading environment. When two people go to war, the foolish man always rushes blindly into battle without a plan, much like a starving man at his favourite buffet spot. The wise man, on the other hand, will always get a situation report first to know the surrounding conditions that could affect how the battle plays out. Like in warfare, we must also get a situation report on the trading environment. This means we need to know what kind of market environment we are actually in. We want to know what kind of market environment we are in. Some Forex traders cry saying that their system sucks. Has anyone ever told you that your system sucks? Sometimes the system does, in fact, suck. Other times the system is potentially profitable, but it is being utilized in the wrong trading environment. Seasoned Forex traders try to figure out the appropriate strategy for the current market environment they are trading in. Is it time to bust out those fibs and look for retracements, or are the ranges holding? Just as the coach comes up with different plays for particular situations or opponents, you should also be able to decide which strategy to use depending on the trading environment. Have the ability to decide which strategy to use in different trading environments. By knowing what market environment we are trading in, we can choose a trend-based strategy in a trending market or a range-bound strategy in a ranging market. So choose a trend-based strategy in a trending market. Choose a range-based strategy in a range-bound market. In a ranging market. Oh no, I wrote it the wrong way. Choose a range-bound strategy in a ranging market. Are you worried about not getting to use your beastly range-bound strategy? How about you bring home the bacon trend-based system? Have no fear, the Forex market provides many trending and ranging opportunities across different time frames wherein these strategies can be implemented. By knowing which strategies are appropriate, you will find it easier to figure out which indicators to pull out from your Forex toolbox. For instance, fibs and trend lines are useful in trending markets, whilst pivot points, support and resistance levels are helpful when the market is ranging. Fibonacci and trend lines are useful in trending markets, pivot points and support and resistance levels are helpful when are useful in ranging markets. Before spotting these opportunities, you have to be able to determine the trading environment. The state of the market can be classified into 3 scenarios: trending up, trending down, or ranging. Yep. So, what is a trending market? What is a trending market? A trending market is one in which price is generally moving in one direction. A trending market is one which the price is generally moving in one direction. Sure, the price may go against the trend every now and then, but looking at the longer time frames would show that those were just retracements. So got the overall downtrend, serves up dudes. Trends are usually noted by higher highs and higher lows in an uptrend, and lower highs, lower lows in a downtrend. So uptrend, higher highs and higher lows. Downtrend, lower highs and lower lows. When trading in a trend-based strategy, traders usually pick the major currencies as well as any other currency utilizing the dollar because these pairs tend to trend and be more liquid than other pairs. Trend-based strategy usually use major pairs as well as currency containing dollars. Traders using trend-based strategy usually use major pairs, usually trade major pairs. When trading, yep, liquidity is important in trend-based strategies. Liquidity is important in trend-based strategy. The more liquid a currency pair, the more movement, aka volatility, we can expect. The more movement a currency exhibits, the more opportunities there are for price to move strongly in one direction as opposed to bouncing around within small ranges. Other than eyeballing price action, you can also make use of technical tools you have learnt in the previous sections to determine whether a currency pair is trending or not. ADX in a trending market. A way to determine if the market is trending is through the use of the average directional index indicator, or ADX for short. So a way to determine the market is trending. Average directional index can be used to determine if the market is trending. Developed by J. Wells Wilder, this indicator uses values ranging from 0 to 100 to determine if the price is moving strongly in one direction, i.e. trending, or simply ranging. Values more than 25 usually indicate that price is trending or is already in a strong trend. Average directional index value of more than 25 usually indicates that price is trending or is already in a strong trend. The higher the number is, the stronger the trend. The higher the number is, the stronger the trend. However, the ADX is lagging indicator, which means that it doesn't necessarily predict the future. It is also a non-directional indicator, which means it will report a positive figure whether the price is trending up or down. Directional index is a lagging indicator, so it doesn't predict the future. Average directional index is a non-directional indicator, meaning it will report a positive number whether the price is trending up or down. Take a look at this example. So ADX of more than 25 usually indicates a trend. This is a value of 39, I think. Price is clearly trending downwards even though ADX is greater than 25. Moving averages in a trending market. If you're not a fan of the ADX, you can also make use of simple moving averages. Check this out. Place a 7 period, a 20 period and a 65 period simple moving average on your charts. Then wait until all the three simple moving averages compress together and begin to fan out. If the 7 period simple moving average fans out on top of the 20 period simple moving average and the 20 simple moving average on top of the 65 simple moving average, then the price is trending up. So moving averages compress together and then fan out, so they start growing apart from each other. So uptrend is the 7 above the 20, above which is above the 65. On the other hand, if the 7 period simple moving average fans out below the 20 period S simple moving average and the 20 simple moving average is below the 65 simple moving average, then the price is trending down. So they're all grouped up together and it fans out. So if it's a downtrend, the 65 is on top, 7's at the most bottom. And if it's an uptrend, the 7's at the top and the 65's at the most bottom. Right, so simple moving averages. Can be used to determine the trend, the market trend. Uptrend is equal to 7 SMA over 20 SMA over 65 SMA. So 7 SMA on top and 65 SMA on bottom. And then for the downtrend, is 65 SMA over 20 SMA over 7 SMA. 65 SMA on top and 7 SMA on bottom. Bollinger Bands in a trending market. One tool that is often used for range-bound strategies can also be helpful in trend discovery. We're talking about Bollinger Bands, or just bands. One thing you should know about trends is that they are actually quite rare. Contrary to what you think, prices really range 70 to 80% of the time. In other words, it is a norm for the price to range. So if the price deviates from the norm, then there must be a trend, right? What is one of the best technical tools we have mentioned in the previous grades that measure deviation? If you said a ruler, we'll give you mad props for effort. If you said Bollinger Bands, we'll give you cyber milk and cookies. Here, take some. Bollinger Bands actually contain the standard deviation formula, but don't worry about being a nerd and figuring out what it is. Here's how we can use Bollinger Bands to determine the trend. Prepare for craziness. Oh, right, okay, this. Place Bollinger Bands with a standard deviation of 1 and another set of bands with a standard deviation of 2. You will see 3 sets of price zones: the sell zone, the buy zone, and the no man's land. Oh, I don't remember this actually. So, let me just reread that. Place Bollinger Bands with a standard deviation of 1 and another set with a standard deviation of 2. Red bands is standard deviation of 1, so it's these. Blue band's standard deviation of 2, so it's the outside. So red goes here, red goes here, blue's here, blue's here. The sell zone is the area between the 2 bottom bands of the standard deviation 1 and the standard deviation 2 bands. Bear in mind that the price has to close within the bands in order to be considered in the sell zone. The buy zone is the area between top 2 bands, so these area, of the 1 standard deviation, 2 standard deviation bands. Like the sell zone, the price has to close within the 2 bands in order to be considered in the buy zone. Right, Bollinger Bands. One tool that is often used. Bollinger Bands, so prices really range 70 to 80% of the time. That's actually really surprising though. 70 to 80% of the time, price is ranging. So that means like it's really uncommon for price to actually like be in a trend. It'll always be just bouncing around between a high number and a low number. Bollinger Bands contain standard deviation formula. I think it should be much easier for me to just include this photo and explain what the photo means. One, the centimeter. 2, you see 3 zones: the sell zone, the buy zone, and the no man's land. The sell zone is the area between the 2 bottom bands of the standard deviation 1 and the standard deviation 2 bands. The area between the 2 bottom bands of the standard deviation and standard deviation 2 band. Bear in mind that the price has to close within the bands in order to be considered in the sell zone. The price has to close within the bands to be considered in the sell zone. Buy zone, the area between the 2 top bands of the standard deviation 1 and standard deviation 2 bands. The price has to close within the bands to be considered in the buy zone. The area in between the standard deviation bands, so between the standard deviation bands, so just between the middle standard deviation bands, between standard deviation 1 bands, area between standard deviation 1 bands. The market is struggling to find direction. Price will close within this area if price is really in no man's land. Price direction is pretty much up for grabs. The Bollinger Bands make it easy to spot a trend visually. Downtrends can be confirmed when the price is in the sell zone. Down trends can be confirmed when the price is in the sell zone. Uptrends can be confirmed when the price is in the buy zone. So if the price is here, it's in an uptrend, but if it's in here, sell zone, then it's in the downtrend, which it is. Very good. What is a range-bound market? What is a range-bound market? A range-bound market is one in which price bounces between a specific high price and low price. Market is one in which price bounces between a specific high price and specific low price. The high price acts as a major resistance level in which the price can't seem to break through. Likewise, the low price acts as a major support level in which price can't seem to break as well. So high price acts as a major resistance. Low price acts as a major support. The market environment movement could be classified as horizontal, ranging, or sideways. Market movement classified as horizontal, ranging, or sideways. I am rubber, you are glue. Whatever you say bounces off me and sticks to you. It is also known as choppy market or simply as being choppy. Choppy market is the opposite of a trending market, kind of like choppy waves in the ocean. In a choppy market, there is no clear direction and the price just chops around or chops up and down and trades in a very narrow range. Trend traders tend to get chopped up in choppy markets. What is the favorite food of a range-bound trader? Chop suey. Suey. Suey? Chop suey? Okay, let's get back on topic. Chop chop. ADX in a ranging market. One way to determine if the market is ranging is to use the same ADX as discussed in the ADX lesson. A market is said to be ranging when the ADX is below 25. Remember, as the value of the ADX diminishes, the weaker trend is. So, average directional index, value of less than 25 means the market is ranging. So remember, if ADX is below 25, then the market is ranging. So this is a 25 line. All of here is above 25, so this section here is ranging. Below 25, it's range. Oh no, below 25 is ranging, but above 25, this here is trending. This bit is ranging again. This bit's trending. This bit's ranging, and this bit's ranging as well. And remember, the ADX doesn't tell you the direction of the trend, so it only tells you the strength of the trend. Hence why, even though that's a downtrend, it still have positive numbers. Bollinger Bands. In essence, Bollinger Bands contract when there is less volatility in the market and expands when there is more volatility. Contract when there is less volatility and expands when there is more volatility. Because of that, Bollinger Bands provide a good tool for breakout strategies. When the bands are thin and contracted, volatility is low and there should be little movement of price in one direction. However, when bands start to expand, volatility is increasing and more movement of price in one direction is likely. So we've got 14 period Bollinger Bands with a standard deviation of 1, which shows here. So we can see that as it gets more narrow, starts to expand, volatility is so when thin, volatility is low. So we can see that this bit here is really thin, which means the volatility is really low. So which it is, because there's not much trend going on, it's just going up and down, up and down. But this one, it's expanded, which means there's really high volatility, so there's an uptrend, which is not an uptrend, but there's a trend which is very likely forming, and we can see that there's an uptrend here. Generally, range trading environments will contain somewhat narrow bands compared to wide bands and form horizontally. In this case, we can see that the Bollinger Bands are contracted as the price is just moving within a tight range. The basic idea of a range-bound strategy is that a currency pair has high and low price that it normally trades between. By buying near the too low price, the Forex trader is hoping to take profit around the high price. By selling near the high price, the trader is hoping to take profit around the low price. Popular tools to use are channels, such as the one shown above, and Bollinger Bands. Using oscillators like stochastic or the relative strength index will help you increase the odds of you finding a turning point in a range, as they can identify potential oversold and overbought conditions. Here's an example of GBP/USD. So this is stochastics here. So for the stochastics, we only look at the tops and the bottoms. So this lines up here. After oversold, price goes back up. After overbought, price goes back down. Boom, boom, boom. Bonus tip: the best pairs for trading range-bound strategies are currency crosses. By crosses, we mean that those pairs that do not include the USD as one of the currencies in the pair. Oh, because they say that the liquid ones are good for trending markets, so the ones that include the USD in it. Yeah, I think they said that before, yeah. So what was this one? What was I saying? This one, uh, trend ranging strategy, GPBUSD, bonus tip. Best pairs for training range bound strategies are currency crosses. Best currency pairs to trade range bound strategies are currency crosses. So pairs which don't include USD as one of the currencies in the pair. Turning point in a range. Oh, like stochastic. Oh, right, I see what you mean. I see what they mean. Oh, I see what they mean. Sorry. Help you find the turning points. So stochastics. Here, so it's below, was it the 20 and the 80? Below 20, above 80. So we can see that when it hits below 20 here, we can see the turning point showing up, which it has. And when it hits above 80, there's another turning point, which it is. And then another one here, so it goes from downtrend to uptrend, from here, uptrend into downtrend. Right, okay, so I see what they mean by use the stochastic. Right, okay. Because then you would know when to start, like, say, so over here you'd start to buy, and then over here you start to sell. The basic idea of a range bound strategy is buying near the low price and selling near the high price. Use of oscillators such as the stochastics, RSI or relative strength index will help find the turning points in a range. Do that, boom, bang. Do not USD. Currency pair. Most EUR CHF. The similar growth rates shared by the European Union and Switzerland pretty much keep the exchange rate of the US Euro CHF stable. Another pair is AUD NZZ. AUD NZD. Not NZ dead. Conclusion: whether you're trading a pair that's in a trending or a ranging environment, you should take comfort in knowing that you can profit whatever the case may be. Find out how you can pick tops and bottoms in both trending and ranging market environments. By knowing what a trending environment and a range-bound environment are, and what they look like, you'll be able to employ a specific strategy for each. As the old wise man in Central Park says, only a fool dips his cookies in habanero salsa. I do not know what that means, but let's move on. Trend retracements or reversal. Imagine this scenario: price keeps rising and then it starts falling and falling some more and falling some more, and then it starts going back up. Have you ever been in a situation before? Oh, the downtrend is losing steam. Time to buy and make some pips. It looks as though the price action may be rallying and the buy trade is in order. Wrong. So we're here. Boing. What the heck? What happened to my pips? You've been hit by the smooth retracement. Nobody likes to be hit by the smooth retracement, but sadly it does happen. Why? In the above example, the Forex trader failed to recognize the difference between a retracement and a reversal. Instead of being patient and riding the overall downtrend, the trader believes that the reversal is in motion and set a long entry. Whoops, there goes his money. Check out how happy Pip got fooled by the smooth retracement in one of the AUD USD trades. Trend line break. In this lesson, you will learn the characteristics of retracement reversals, how to recognize them, and how to protect yourself from false signals. What are trend retracements? A retracement is defined as a temporary price movement against the established trend. A temporary retracement is a temporary price movement against the established trend. Another way to look at it is an area of price movement that moves against the trend but returns to continue the trend. So we've got the overall trend which is going up, but retracements move against the trend, so we can see here there's a bit of going downwards here, going downwards here. This is not retracement because this is the overall trend, because all of it is pretty much going down. But there's a bit of retracement here which goes up, retracement here goes up, retracement here goes up, retracement here goes up as well. Easy enough, let's move on. What are trend reversals? A reversal is a change in the overall trends of price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal also occurs. Using the same example as above, here's how a reversal looks like. So you can see the overall uptrend is here, a reversal point is somewhere over here, and it drops straight back down, which is a downtrend. So here the reverse happens from an uptrend to a downtrend. But why is that point the reversal point? And why can't it be, oh, I guess it's all that bit there. Yeah, it would be that bit there. Yeah, I thought I was gonna say it's like, why can't it be that bit there? But I don't know, to be honest. Don't know. What should you do? When faced with a possible retracement or reversal, you have three options. If in a position you could hold on to your position, this could lead to losses if the retracement turns out to be a longer term reversal. So three options when faced with a possible reversal or retracement. If in a position you could hold on to your position, this could lead to losses if retracement turns out to be a longer term reversal. When faced with a possible trend reversal, you have three options. Three options when faced with a trend reversal or retracement. Hold on to the current position. Could lead to losses if the retracement turns out to be a reversal. Close your position, close the position and re-enter, which is if the price starts moving with the overall trend again. Of course, there could be a missed trade opportunity if the price sharply moves in one direction. Money is also wasted on spreads if you decide to re-enter. And re-enter if the price starts moving with the overall trend. Again, could be a missed trade opportunity if the price sharply moves in one direction. Price sharply moves in one direction. Money is also wasted on spreads when re-entering. Last one, you could close permanently. Close the position permanently. This could result in a loss, so could lead to a loss. If the price went against you, or lead to a profit. If you close at the top or bottom, or lead to a profit, depending on the structure of your trade and what happens after. Depending on the trade structure and what happens after. So close permanently if you close at the top or bottom, depending on the structure of your trade and what happens after. Because reversals can happen anytime, choosing the best option isn't always easy. This is why using trailing stop loss points can be a great risk management technique when trading with the trends. Trailing stop loss can be used when trading with the trend. Isn't that the one where the stop loss keeps moving up or down to follow the trend so that you can, I guess, hold on to your pips more, like get a more definite profit in instead of just like hoping it'll hit your take profit level or stop loss or whatever, right? Not your stop loss, but like you'll be able to lose less because you could always just instantly close positions which is above your original starting position, so you would lose less, if that makes sense. I don't think it does, but yeah, hopefully it will re-explain that later, what the trading stop loss, a better definition than mine one. You can employ it to protect your profits and make sure that you always walk away with some pips in the event of a long-term reversal happens. Oh, there we go. That's a better explanation. Okay. I am going to leave this episode here. So in the next video, we're going to be carrying on with the, I guess, trending, oh no, market environment, with how to identify reversals and retracements. So thank you guys for watching this episode, and I will see you all in the next one. Goodbye.